Welcome, everyone. Hope wherever you are, you're staying warm. It's if you're in Florida, which I'm sure most of you are, it's not our normal stretch of cold weather. Anyway, as Kevin said, my name is Sherry Ward, and I'm a regional general manager with Vesta Property Services and have been with Vesta for almost 6 years. And I've been working with community associations since 1998. So yeah, I started young. Um, a big thank you to the Vesta marketing team, Kevin and Kristen, for helping us coordinate this session. And we put together a great panel for you today. First, we have Ed Ronsman, who is with McCabe and Ronsman. He has been in the business for 17 years as a condo attorney, and they serve over 1,000 clients across the state. And he's a board certified condominium plan development law and frequent presenter with us here at Vesta, and is also the past president of the local CAI chapter. Next, we have representing Reserve Advisors, Matt Queasley. Matt has been in the industry for 25 years and was part of the team that helped write and revise international reserve study standards. In his spare time, he also serves bravely as a treasurer on his own association board. And lastly, we are joined also by Nico March and his team. Nico is the founder of the March Group and is a 43-year veteran of the industry who's provided financial services to hundreds of Florida associations. He is also an author, a member of Community Association Institute, and an approved Florida CEU instructor. He'll be sharing his ideas on how associations can responsibly manage and grow their reserve funds. Together, our speakers will discuss how associations can move from simply setting money aside to managing reserves funds more strategically and supporting long-term stability and stronger financial performance. And as Kevin mentioned, please make sure any of your questions go in the chat so we can address them at the end. And with that, we'll get started.
All right. Well, good morning, everyone. Thank you, Sherry, for the introduction. Thanks, everyone. I'm excited to be here. I'm Ed Ronsman with McCabe Ronsman. Happy to talk with you all about just some of the topics for today on reserves and investments with those and being prudent with that. And so we have some topics here that we'll talk about. First, I want to just dive into the fiduciary duty of board members. So what this is the highest duty afforded by common law. It means that you have to act in the best interest of your community association members, and you must act as a reasonable person would. What I like to say, I actually just taught one yesterday. I teach it frequently as a new board certification class for board members. And it doesn't mean that you have to be perfect. What it means is that you have to act as a reasonable person would. And what that means is really working with professionals that know what they're doing in the industry that they're in so that you can take the best advice possible when you're making your decisions. That's the best way for you to accomplish your goals, your obligations as a board member, and understanding that. Obviously, the big thing to be mindful of and where board members can get in trouble is if there's anything regarding personal gain, self-dealing. It's rare that we see that, but some stuff that we do see, it comes up in the news. We've probably maybe heard of a couple instances across the state. That's where board members can get in trouble. It doesn't happen very often. As long as you're acting as a reasonable person, you're going to be doing a good job and working on behalf of your members. But remember, you are working on behalf of the association, and it is a corporation that you're operating too. It's a not-for-profit corporation, but you're running it as a business. So acting as a business owner would and relying upon the advice of professionals is key. Going into just some of the reserve fund laws and what some of the compliance requirements are, in the Condo Act, there have been mandatory reserves. Every condo has a roof, every condo has a building that needs to be painted. And so there are certain mandatory reserves that have always been in place, right? One of the things, and I'm going to kind of blend in here some of the changes from the past legislative session, is that there's also a catch-all beyond kind of the listed components. It used to be for any item that had a deferred maintenance or replacement cost of $10,000 or more. That's been exceeded now. It goes up to now it's 25,000 or more. So if you have something, I guess, between 10 and 25,000, that no longer has a mandatory reserve requirement because they've increased the kind of the threshold there for that. But that's one of the things just to be mindful of. But you have what are called mandatory reserves on the condo side. If you have structural reserves, which we'll probably go into more detail here today, those obviously have come out of the legislation from the Surfside Tower collapse. That's for three-story or higher residential condominiums that have three habitable stories or more. That was one of the recent tweaks where they added the word habitable in there. Probably many of you, if you're in one of those, are familiar with that. There was a recent deadline to have that, what we call the SIRS, the SIRS, completed by the end of last year. It's meant to address and identify all the structural components within your building. And the main point here is that when you have those structural reserves, you cannot use those funds for anything other than those structural components. You cannot vote to waive or reduce those reserve items. And so you can see the intent there is to stay on top of your structural components, making sure that you're fully funding them and not using them for other than intended purpose. On the HOA side, for reserves, it's a little bit different. The only type of what are called a statutory reserve are reserves that are voted on by the homeowners. It used to be that a developer created reserve was called a statutory reserve. Now you have the only type is when the homeowners vote to create them. Usually, what we find representing homeowners associations is most reserves are either created by the developer initially or established by the board because they're discretionary authority within your governing documents. When you have that, it's a little bit different on the funding formula requirements there. If it's not a statutory reserve, most communities kind of follow the more strict funding formula. That's usually the best practice for it. But I would, it is a little bit different than from the condo side as to the funding requirements for that. If you don't have statutory reserves for HOAs, there is a requirement in your financial disclosure that's set out in the statute that lets people know, hey, it's basically, I'm paraphrasing here, but it's a little bit looser. There may be a special assessment at some point based on how these reserve funding is going. And so that's something just to stay on top of and understand that when you're governing your community and establishing your reserves and some of the reporting requirements. In terms of anything else regarding House Bill 913 that passed last year, a couple things of note. I already mentioned a couple of them. The law did state, it clarified that you can create pooled reserves if you didn't have them already through a board vote. Previously, the advice given by attorneys was that you may have needed a one-time membership vote to go from what are called straight line reserves, where every reserve component has their own funding and you can only use that for that purpose. That you'd have that one-time vote to go from straight line to pooled. Now it's actually, they've clarified it that it's a board vote. They also clarified that you can have pooled structural reserves, but you have to keep those separate from your non-structural reserves if you're in a three-story or higher condo. Um, they also added some flexibility for meeting your reserve funding requirements on the structural reserves by allowing you to pass a special assessment, have a line of credit, or a loan. There's some exceptions there if it's a developer-controlled community, if the turnover was within the last year, or if it's controlled by one or more bulk assignees or bulk buyers. That's not a typical occurrence. That's where there's an exception to that. You do have to have a member vote, though, if you're going to have that alternative funding formula for your reserve. So that's from some of the recent legislation that we've seen. The other thing of note, and obviously really in line with our presentation today, is that the statute, was amended to clarify that you can invest your reserve funds and you need to do that prudently. And so what you need to do is work with professionals that know what they're doing. We have some great presenters here that will be talking about that with you all. Making sure that you're making prudent investment decisions with those reserve funds. I like to joke, you know, CDs, money market, and I know Nico can talk a little bit more about this. Crypto, maybe not, right? And so, making prudent investment decisions is really important. And then just the risk of mismanaging your funds. There's some personal liability there if there's any type of breach of fiduciary duty. Again, working with the appropriate people to help make those decisions, I think you're going to be in good shape. But obviously, it's everybody's funds that are at risk, and you want to make sure that you're making good decisions with that. And so I know we'll provide you with more information today as we go along. And I'm happy to answer any questions too at the end, but I know we want to make sure that we get you all the information here. So thank you all for allowing me the opportunity to present, and I'll make sure to stand on for any questions at the end.
Great. Thank you, Ed, so much. Next, we have Matt to talk about reserve studies.
Yes, thank you for having me. And Ed, great job of summarizing this little piece of legislation that's 191 pages that I still have in front of me in like a couple of minutes. There's so much in there.
I talk really fast, so thank you all.
There's so much to it, and we won't probably you certainly don't have time to get into all the details of the nuances. But I want to touch on some of the basics, and Ed mentioned it too. The need for these plans have always been around, and I think some of the objectives that we hear all the time in our board meetings is, well, we're not going to be here in 5 years, or we're not going to be here in 10 years. Why would we worry about that? And so I always remind them of their fiduciary duty, Ed, and I say, remember, where you're going to be is kind of putting your own personal interests in front of that to whom you own the duty, which is the association. So I say, you may not be here. In fact, most of this board hopes you're not going to be here, but if you are here, you're here today to protect the community association, the condominium association incorporated, and if that's going to be here, that's what we do with reserves, and it's just come into such a spotlight after the tragedy in Surfside in June 24th of 2021. We used to think, the worst thing that could happen is we'd have to have a special assessment, or we'd have some deferred maintenance on a property. We never could imagine the tragedy of a building completely collapsing, 98 people dying in the middle of the night. So the legislature had to react with this, but it reacted in a way that said, yeah, some of these items are must-have, some of them are a good idea to have, and they kind of drew the line in some gray areas, and it's gotten very, very confusing. It's gotten very um, uh, different from year to year, a lot of changes and hard to follow. So kudos to you board members and others that are on the call today. Try to get a little bit of information for it. There's a lot more information out there. I want to point to one new website that the state has. It's called condos.myfloridalicense.com. Um, and that's a good resource with a lot of information about all the new requirements for condos specifically. And then just yesterday, the division released their new budgets and reserves training manual for condos to try to help take all of the laws that have created and help people implement their requirements for the structural integrity reserve studies and reserves in general. Reserves at their very heart are important for everyone, because there is no defeating Mother Nature and Father Time. They are going to eventually cause for repairs, and every property, whether it's a high-rise building or an HOA with some ponds or roads, are going to require maintenance or repairs or replacements over time. Inevitably those cost money, and without the money they don't get done, they get deferred. And what happens in most cases with those types of repairs is they get more expensive if they get deferred. So it's so important to have the funds available for a board. It's not an easy job. I know, as Sherry mentioned, I've been on my board for a long time, and it's never fun to tell your neighbors that we need to collect a little bit more each month, but it is absolutely the responsible thing to do. And one of the things that I try to communicate to folks is that it's not for that rainy day 20 years from now when we're going to need the money. We're enjoying the use of the roof or the pond today and every day in the Florida sunshine. That's wearing and tearing, and its life is expiring. So it's super important to be setting aside some funds for its eventual repair or replacement, and really it should be equitable for the amount of time that you stay there. So if you're living in the community for 6 months, you should pay your 6 month fair share. If you live there for 16 years, you should pay your 16 year fair share, and the best way to do that is with your regular assessments. And so the reserve study is the tool that tells you how to set those assessments. And I already saw some great questions in the chat. Keep those coming, because we'll get into some of those details. But at a high level, reserve studies, a physical and a financial analysis. They're not overly complicated. There's three basic things. We got to get the right items in your reserve schedule. So we do a reserve component inventory. There's a 3-part test that CAI, Community Associations Institute, has developed in their standards, and it's very simple. It has to be the association's responsibility. It has to have a predictable and known remaining useful life, and it has to have a cost above a certain threshold. And those are kind of the three. If it hits those three things, it should probably be a reserve component. But it's probably the biggest mistake mistake that we see associations make is they just overlook items. So many items are out of sight, out of mind. We just had a big irrigation project come up yesterday that people hadn't been thinking about because you don't see all the pipes and valves below ground on the irrigation system. Especially if it's going off at night or earlier in the morning, and you don't even see the heads pop out sometimes. So just thinking about all those things, getting the right items on your list, assigning a realistic useful life and a realistic repair or replacement cost. I mean, that's really the basics of a reserve study. And some boards do this themselves, but I think as a prudent person, when you realize all of the different fields that fall into reserves, whether irrigation or pavement or roofing or concrete restoration or building envelope work, most boards are just simply not equipped to have that knowledge in-house. So most will hire a professional to do that. It is only required in the state of Florida for SERS buildings, which are now, as I mentioned, 3 habitable stories or more residential condos, and 1 unit, 2 unit, 3 unit, or 4, I guess you call it 4 family dwellings are excluded as well. So there's some exclusions of who has to do them. But everyone most likely can benefit from a reserve study, a traditional reserve study. Most of our SERS clients, where we had the 3 stories, we did about 1,000. We looked at the first 1,000 that we did, and we looked at all the data, and thankfully we were able to convince about 95% of them to look at both sides, both the structural and the non-structural. They do have to be separated now, and we found that about 2/3 of the components for all of those buildings at the macro level related to SERS. So 2/3 of the dollars are related to SERS items and about 1/3 related to non-SERS components. So significant amounts in each bucket overall. And as far as the timing really identifies the funding or demands the funding. And so those can be a little bit varied on a case by case basis, but at a high level, 2/3 SERS, 1/3 non-SERS. Don't forget about the non-SERS. The non-SERS components, I think as Ed mentioned, can still be waived, but it takes now a majority of the voting interest to waive those in a condominium. Most HOAs, and I'm glad you mentioned that, Ed, don't have the statutory reserves that I run into. Very, very few of them actually have gone through that step to get the owner vote. They're out there, but it's I would say vast majority are non-statutory reserves, which means they don't have to fund them every year. Their use is not necessarily restricted, and that gives some boards pause. So it's something to think about if you're in an HOA. Really just important, and I would say many don't know whether they have statutory or non-statutory because you haven't looked at the minutes for the last 30 years and don't know what was established and how it was established. So that's just a few things to think about. One of the really ensuring the proper financial health has become paramount, as whether the state acted and created these SERS laws or the industry acted. It was just a matter of time until people started looking much closer at associations' finances before they would do things like approve mortgages, lend money to the association, or insure the property. So now those industries are asking they're asking more questions. Buyers are asking more questions. And so the microscope is on associations. There's bad stories out there. There's been many buildings that have had to be evacuated because of their physical health, and many more that have had to, undertake some really significant special assessments or financing to achieve the projects and really bring the buildings into safe conditions. And so the reserve study, gets you there. It's a key document for associations of all shapes and sizes. And also, as I kind of turn it over to Nico here, really allows you to be strategic with your funds, because there are going to be some projects where you're going to lock up money for a very long period of time, and you can use that ability, the power of that, to really invest those and get the most out of your funds, so that you're again being a fiduciary, protecting everyone's investment, and that's our job as board members, right? Is to protect the investment. My home is one of my biggest assets, my biggest tangible asset, and I want to make sure that it's protected. And I think that's why most of us serve on our board. So having that tool and that ability to say, okay, what's the most strategic way we can save these funds is of utmost importance. And Nico, let you take it from here on what we're going to do once we identify the funds and start saving them for those projects.
Beautiful. Thank you, Matt. Good morning, everybody. You heard the term fiduciary. You heard protect, maintain, and enhance. And I will say that I got on my first board in 1974. I was the treasurer as well. So Matt and I have sort of had the scars to show for serving on a board of directors as long as we have. Matt hit a very important point that I want to stress. Your condominium is the largest personal investment that most of us will ever make. So the reason that I got on my first board was I was concerned about the value of that particular investment. And I wanted to make sure that that value increased over time. So when I decided to sell, it would be worth a lot more money than what I had put in. Now, because of inflation and everything else, yeah, a lot of that has happened. But many of you on the call have also seen the cyclical nature, especially in Florida, as to the pricing of real estate. So the idea of protecting, maintaining, and enhancing that investment is really where a lot of us come in, from the fiduciary standpoint, helping others, but also from the standpoint of making sure that we are all doing the right thing. Now, I have a couple of associations that I've worked with in Florida. One of the first ones was the one that Sherry actually managed back in 1998. So we've been around for a long time taking care of these things. So part and parcel of what we are here to do is to help educate people. The more education, the more information that you can have, the better off you're going to be, because some of these laws, as they are changing, and some of the generally applied principles or best practices are the best way for you to help as board members and managers, the constituents, to protect those assets. I am the co-author of the CAI book, Reserve Studies and Funds. We are actually in the third edition. For those of you that may not have a formal investment policy statement, there is a copy or a couple of copies of different policy statements. It's the most important piece of documentation that you can have in regards to your financials. I always tell our boards, have your attorney review this. We like to review the investment policy every year with our boards, because of the fact that this is the stipulation as to how you should be investing your funds, what the board has approved, timelines, vehicles, risk parameters. Those are all inclusive in an investment policy. But what the most important part of this is the continuity. Because, Matt, how long have you been on your board now?
Little too long. I had a 2-year hiatus, but it's 16 years minus 2, so 14 years.
Okay, so you are a glutton for punishment.
Yes.
The fact of the matter is that with this continuity, as board members change, if management changes, you've got this documentation now on file every year to be able to coordinate. And as you pass the baton to a new board member, that documentation goes forward when you might not. Now, the one thing that we ended up doing was we ended up linking the reserve study data to the investment planning process. This is sort of a key, because most people, and if we go back 20, 30, 40, almost 50 years for me, the reserve study was done, but then it sat on the shelf. It was a document that we had to do every few years. And then we looked at it, we said, this looks great. What we found was that if we can marry the reserve study data with the investment planning process, we can generate more money than you can just leaving money liquid in a liquid money market or a bank savings or checking account, as well as some people now just ladder CDs. They'll do like a 3, 6, 9, 12-month, maybe 2 years out. The problem with ladders is that they are dangerous, especially in an economic scenario like we are seeing today. We will probably be back down to a 2% or even lower level within the next couple of years. So the opportunity to extend some of these maturities based upon the specific requirements as spelled out in your reserve study is a very complete and concise way to generate higher returns. But once again, going back to that investment policy, what we always recommend, since it's other people's money, is to put these vehicles into insured, guaranteed, and zero risk to principal types of products. Quick story. Back in 1987, I was working with a number of associations back in Hawaii. And at the time, you might remember, some of you might remember, there was the FSLIC, the Federal Savings and Loan Insurance Corporation. Well, they had a problem in 1987. Some of you may remember that. The stock market crashed. FSLIC basically went out of business, as did a number of banks. There was a management company in Hawaii who actually had invested for their associations $100,000 increments, that was the limit at the time, in the Bank of Honolulu. Well, the Bank of Honolulu went belly up. The $100,000 was returned, but then a savvy board member steps up to the plate and says, wait a minute, what about the interest that we earned? Well, the management company had invested $100,000, and that's all the FSLIC was willing to return. So the management company had to come out of pocket for that interest earning to be able to compensate or keep their clients happy. So these nuances of what you can invest, how much you can invest, how to invest it, how to put those details together is where we come into the picture. We developed what we call a needs-based analysis. It's basically an algorithm where we can take all of that data, we can put it together, we can provide the board with a roadmap. And that's the most important thing that we talk about, is working together with boards and managers on an annual basis, sort of like a medical or a annual physical. We basically do this and call it an annual fiscal or a needs-based analysis. And this, in essence, is like going to the doctor every year, having your blood pressure checked, your lung sounds, your heart rate, et cetera, et cetera. But the idea of sitting with a board and discussing these things either quarterly or every year to make sure that the cost of inflation, goods and services, changes in the legislation, all affect how you're handling these funds and where they should be handled. Now, the other important part, especially in Florida, is to always have a backup. And when I say a backup, I'm talking about the fact that in Florida, if you have a hurricane that rolls through there, you may have landscaping worth millions of dollars that's down. The insurance company is not going to step up to the plate within the first 24 or 48 hours to help you clear the debris. So the idea of having your assets and liabilities together working on behalf of the association and to make the job of the board easier. So it's an asset management, it's a liabilities management, it's a protection scenario. The one case study that I can tell you about that we just took over recently was an association in Florida. They had about $2 million in reserves, but most of it was sitting in a liquid money market or a CDARS type of account. It was earning a little better than 2%. They basically had a reserve study that was complete. They had just done the CSRS report early. This one happens to be in Fort Lauderdale. So what they ended up doing was they ended up engaging us. We took a look at exactly what they were doing, both on the CSRS side and on the typical reserve side, put together this analysis. We were actually able to take them from about 2% up to about 4% with federally insured and guaranteed vehicles. So once again, the idea of engaging experts, looking at other opportunities and where and how, as well as the longevity, especially with some of the experts that we've got on the panel today. That's my takeaway, is always try and work with experts. I like to use the term cover your assets. So thank you so much.
Excellent. Thank you, gentlemen. We do have some questions. The big one is the website that Matt had mentioned, the My Florida license. Can you repeat that, please?
Yep. And I did put it in. If you should be able to see that with
Oh, sorry. Yep. Okay.
with the answer, but it's condos.myfloridalicense.com, and they've been updating that thing really regularly. So as soon as something new comes out or other information, it gets put on there pretty quickly. So a lot of good FAQs and resources for boards and managers alike there.
Okay. Question for Ed from Tom. Are you able to move balances around amongst various reserve types within the reserve account?
Yeah, so the way I saw that was if you had pooled reserves, and maybe Matt, you can help answer this too, but generally pooled reserves it's one, I describe it as kind of one pot of money, and as long as you have you're using that for the proper reserve component, that's included, that's being funded there, then you're okay to use that. If you have straight line reserves, which means that you have a roof reserve and you have a dollar amount allocated to that, you can only use it for that purpose unless you create a pooled reserve or you have a member vote to use it for another purpose. That's kind of what the rule is. But as I mentioned, the good news is that the legislature confirmed that it's just a board vote to go from straight line to pooled reserves now, rather than what we thought may have been like a one-time unit owner vote.
Ted, question for you. And I've heard different interpretations on this, don't mean to put you on the spot, but if they have existing fund, are you saying they have like existing component reserves and
Yep,
they want to use that money and move it into a pooled, is that how you're reading the statutes, that they don't need an owner vote to do that now?
correct. That's the way that
Okay,
we're reading it. Yep.
nice. Okay, that's helpful. I've heard some saying we still need to vote for that, but in the future, a board can pool without the owner vote, but it's not super clear, but I appreciate that
Yeah,
free legal
I,
advice, Ed. Thank
I'm
you.
sure you'll get 10 different answers from 10 different attorneys too.
Yeah, there's a little bit of confusion there, but you're absolutely right. And I think that people historically have had concerns about pooled reserves because they feel a board could use the money poorly or spend something that's not needed. With the SERS reserves specifically, that money is very restricted, so that should put some more control. It does put more control and controls in place for a board to do that. But also, it's never been my experience that boards are out there trying to make those poor decisions in a vast majority of cases. So most associations we're seeing are switching to the pooled reserves. It's been a long process. About 24 years ago, they started to allow pool reserves in Florida. They didn't before 2002. But now most associations are going that way. And I think it works for a lot of folks.
All right, excellent. So Nick has a question about um, the low maintenance HOA who pays for roof replacement every 15 years. Nico, did you want to answer that question?
Sure, be happy to. The question is in regards to funding our next roof replacement by calculating inflation over the next 10 years into what the cost will be. Well, I'm trying to do the math here, and you said here that we last replaced roofs 15 years ago at a cost of 2.5 million. So in regards to calculating that 15 years worth of inflation into the cost, it sounds to me like you're right about ready to replace those roofs again. And I would say that the ideal scenario would be to have somebody like Matt and or an engineer and roofing specialist come in, give you those current costs, since it sounds to me like you're going to be doing that. But in regards to the next roof replacement, yes, I would definitely include that reserve study provider and have them do the calculation based upon the estimation of inflation. Once again, past performance is not indicative of future performance. So I can't tell you that we're going to be seeing this average 2 to 3% inflation when a few years ago we were looking at 8% inflation. So that's the reason that I always recommend that you look at that reserve study and your financial strategy every year with the experts, calculate that into your figures. And then when you go forward on your budget as well as your reserve funding, you calculate the actual numbers in there when you're doing that.
Yeah. If I can add, and Nick submitted later on, I think he meant to say they replaced them 5 years ago at the cost of 2.5. So the math then works out that 10 years they would need replacement. And I would just echo that what we base all of our reserve contributions are annually are the current cost. So while 5 years ago the roof would cost 2.5 million, it would not surprise me at all to hear somebody say now that roof is 4 million or 4.5 million, because 5 years ago was we were in a completely different environment with cost, labor, and material rates. So probably not just inflate the 2.5 million for 15 years at 3%, but look at what is it today. And then going forward, a nominal rate of inflation makes sense. We don't know. We can't predict exactly if it's going to be, it's not going to be 8% for every year for the next 10 years. We hope to God, and it's also not going to be nothing. So we look at historical construction inflation ranging about 3.5% over the last 30 years. So we kind of use that as a nominal rate going forward. But to Nico's point too, you need to be looking at that every so often and have a professional give you an update on what it would cost today so that you can dial it in and stay right on path for that day in 15 years from now. The other thing I'll just mention really quick on the low maintenance HOAs, there are, again, could be other items that need to be on your schedule. Don't just look at the roof. And if you haven't done a study, think about what else might be there behind walls underground. That is an HOA responsibility, because that's where, like I said, most associations go wrong. They get a great plan for a couple of the items that they know they have, and then all of a sudden something surprises them that they didn't have on their schedule.
Great. Thanks, gentlemen. Leo has a question about cash rewards that they receive from Amazon type credit cards when they make purchases from or for the association and how that's treated. So Nico, it looks like you want to answer that one.
I'm going to answer that one with no, absolutely not. Nobody on your board should use a personal credit card ever, never. Don't commingle your personal funds with the association funds. There's a big article going into CAI this month in regards to board members that have had signatory authority and accounts in personal names. Don't ever do that. Ed, can you address what the problem is with putting these things in personal board members' names?
I think you just have so much potential for abuse, whether it's intentional or not, and you have the issue of earning rewards. You have issues with tracking and making sure you're not combining things in orders that may be for your own personal benefit. There's just a lot of issues with it. There's a strict prohibition against debit cards, especially. That's in the statute. In terms of credit cards, it doesn't say you can't have a personal credit card, but as Nico said, highly, highly advise against it.
I'll give you just one quick story. In Las Vegas, we had an association that we took over. We found out that prior to our getting involved, the manager was given a credit card. Their engine blew up one day, and they used the credit card to get a new engine in their personal car. So those are the kind of scenarios that can crop up when you're using any type of credit card, debit card outside of Florida, et cetera, but giving one person access to these accounts is ill-advised. Make sure that you always have at least 2 board members and your management professional looking over these funds, because they can disappear very quickly. Another quick aside was a story about the $5,000 case of light bulbs, where there was an entry every couple of months by a nefarious individual. They would buy a $150 case of light bulbs. It was found out about 3 years into the scam. So the idea of having multiple eyes on your accounts, on the monthly statements, on the disbursements, is what professional managers always look to. Just another piece of advice for board members.
Yes, thank you. This one is for Matt. How much does a reserve study usually cost for commercial POAs?
Love this question. And unfortunately, I can't give a specific answer without knowing more about the community. All reserve studies are generally based on the time that the professionals will spend on the project. So if it's a large community with a lot of amenities, it's going to cost a little bit more than a small community. And then updates of the reserve study are always much less expensive than the initial study. So while I can't give you the exact number, if you want to reach out to me, I'd be happy to get you a proposal after researching your community. Sherry will send out our contact information, and I'll be happy to get you a no cost, no obligation proposal, or anybody listening, happy to give you an estimate.
Okay, and same person, Laura, I would like to ask about how to invest their commercial POA funds. Nico.
Yes, commercial POAs can invest their reserve funds. Once again, depending on how you file your taxes, I'm going to defer to your CPA on that, whether it be the 1120 or 1120Hs were designed specifically for homeowner associations, and of course the 990s for nonprofits. But yes, we have a number of commercial POAs that we invest their funds for. And yes, you can roll that into your reserve funds. I don't know exactly how your POA may have that structured as far as specific reserves. We have a couple of multi unit type of entities where they have a commercial and a residential. So once again, it all depends on how you're structured, but yes, you are allowed to invest those funds.
And then the interest would be rolled over into the reserve funds, correct?
Correct.
Okay. All right. Jonathan would like to know the specific FDIC opportunities that are available to give better returns, Nico.
Well, first and foremost, let me go back to the roadmap. Unless we have a reserve study and all of the data from that reserve study, and I like to refer to that reserve study as being blessed by the board of directors, because there are so many reserve studies out there where you will have board members go, yeah, we're not really quite sure if that's exactly what we want to do or how we want to do it. So we always start with that reserve study as the roadmap. Then we determine which types of vehicles fit those specific requirements. So that's why we refer to that as a needs-based analysis, where you have different tranches of money and different types of vehicles that you can put into it. So you have the government insured or FDIC insured money markets for your liquid money market. Those, of course, are going to be yielding a little bit lower. Then you have an opportunity to move into certificates of deposit insured up to $250,000. If you're doing this on your own, don't put more than $245,000 into any one particular CD. Remember the Bank of Honolulu I just mentioned? Stepping up from there, you can go into US Treasuries. There's bills, notes, and bonds. And then for some of your longer term investments, what we have developed is what we refer to as an equity linked or market linked certificate of deposit. And those are FDIC insured CDs up to $250,000 that are issued by certain money center banks. They usually have a floor of about 1 to 1.5, but they are linked. For those of you that are saying, well, gee, can't we invest in the stock market? Well, this is a way to invest in the market with zero risk to principal. These are FDIC insured CDs. The only difference is that their interest complement is linked to an index that goes up and down. But if you hold the CD to maturity, you're guaranteed your principal plus the interest. If the markets go up, you can generate a reasonable profit on these. Some of them that we've been doing over the past few years with the markets doing what they're doing have been generating anywhere from 7 to 9% on an annualized basis. And once again, past performance is not indicative of future performance. You need the roadmap first, then you plug the vehicles in.
Great, thank you. Roger would like to know what additional training is required for HOA board members. Ed would like to answer this one.
Yeah, so it's a little confusing how they did it. So there's a 4-hour course that you have to take as a new condo board member. And of course, then they have different time periods for when you have to retake the class. For HOAs, you have to take the board certification class, but it does not have a minimum time limit, or a maximum or whatever. There's nothing stated there. So the 4 hours is the annual education requirement each year that you have to complete for homeowners associations. For condos, it's a longer board certification, but for a continual basis, it's a legal update if there is a statutory change affecting condos. I know it's confusing, but a lot of questions regarding that on the continuing education requirements.
All right, Matt, special assessments how are they allowed to be used to fund an underfunded reserve account?
Sure. So in the statute clarified even with SERS, we've been doing this before, but 913 clarified it that reserve funding can include special assessments. What we can't show is a deferred special assessment. So we can't sit here today and say in 10 years we're going to special assess for that roof because I don't want to pay for it today. Like it can't be a deferred special assessment. It could be an immediate special assessment, meaning it could happen right now to make up for funding in the past or to prepare for a project that's needed in the immediate near term. So it can't be like I guess that kind of covers it. And then the next,
yeah, that next question. Yeah. Yeah, hopefully you understand that because I'm not sure how.
Special assistance. So this is kind of what I was saying is that you can't decide that in the future we're going to special assess for that project. So the reserve schedule that you would put out would be um, for the full reserve amount, not 100% of the fully funded balance, but we won't have time to go into that today. But that, just to be clear, is that the 100%, when you say that, it makes me think like we have to have 100% of the item or 100% of the balance on hand. That's never the case in Florida. But nonetheless, um, to avoid getting too far off track, the plan would have to be to the membership that we're gonna show the budgeted amount to fully fund the reserves. I call it adequately funded, just making sure that we're not waiving the reserves, but then the membership in an HOA with statutory reserves or non-statutory reserves wouldn't matter, but if it's statutory reserves for an HOA or a condo that's not subject to the SERS laws, I think they can vote to the owners could vote to waive the other, in this case, 30%. And so that would be the way that the board could accomplish that plan if that's what they wanted to do, to give the full amount to the owners and then let them vote to waive the full amount and fund just 70% of that amount.
Got it. Should a new item that needs to be done this year be added to reserves? Um, sorry, and then be withdrawn the same year? I'm guessing that one's for Matt too.
Yeah, that's a good question, and I guess when we say a new item, I'd have to clarify, is that an item that doesn't currently exist? Is that an improvement to the association, in which case reserves should not be used for it at all? Or is it an item that is new on the schedule but has always existed in it? We used irrigation, so I'll stick with that one before. Maybe you didn't have irrigation system as a part of your reserve schedule in previous years. You had the irrigation system, you just overlooked that it's going to need some significant repairs, and now the repairs are due. So no, the reserves can only be used for their intended purpose unless approved in advance by a majority of the voting interests. So they would not really be able to take, if it's a new item that's not on the reserve schedule, you can't use those reserves, even if they're pooled reserves, for something that's not part of the pool currently.
I'll add something to that, Matt.
Yeah.
A lot of associations, and especially older associations, are doing capital improvements. So they're upgrading a lot of their older, whether it be infrastructure, whether it be adding new lighting or things of that nature. Those items, while they may be new or capital improvements, can then be added into the reserve study for the ongoing maintenance. And that's one of the things that we see, or Matt and I have seen over the last 20, 30, for myself, 50 years. Some of these items have to be replaced and or upgraded. So yes, absolutely. You can put it in and take it out. That's the discretion of the board, but that's also how a lot of boards have gotten into trouble, by removing items from their reserve study to artificially keep the budget in line or without increasing dues. Highly not recommended.
Right. I'm not sure who would like to answer the one about the reserve study impacting the resale value of the building units.
I'd like Ed to chime in, but I would like to say that every association that we have worked with that has a reserve study and sticks to it and is funding to that reserve study shows a fulfillment of their fiduciary responsibility to protect, maintain, and enhance their community. And that in turn, in the real estate market, does get a little gold star next to that particular community versus the guys across the street that may not be following through on that.
Yeah,
Ed?
I can speak just from personal experience. My mom moved down from Wisconsin to Florida and bought a condo, and doing this, and this is the only area of law that I practiced in. The first thing I said was get a copy of their reserve study and their financials. I want to see if they're fully funding their reserves and they have a healthy reserve balance. So to me, it's a little bit different from what the question asked. I think what we say too, and it's a little bit different, but just like if for reserves, you're going to have to do it. If you have construction defects, there's a problem whether you bring a claim or not, right? And so I think if you show that you're working with the right professionals, that you're attacking and making sure that you're addressing the issues, that's going to help you. Because if you don't fund the reserves, then there's going to be a special assessment later on, right? And so I know that was the case. And in the example for my mom, great. She had fully funded reserves in there. They had just replaced the roof, so felt a lot better that she would be moving in and not get hit with a special assessment right away.
Real quick, I'll just add Fannie Mae and Freddie Mac have a blacklist. It's over 5,000 associations at last count. And one of the reasons you find yourself on that blacklist is that you don't have adequate reserves or you don't have an adequate reserve. So you need to tell that story of why your reserves are not adequate. And so if you don't have, if your community is not eligible to um, qualify for those federally backed loans, most banks won't write mortgages for the community, which can make it harder to find, shrinks your pool of buyers, and of course would impact resale value.
And I'll refer back to CAI for any of you that are not familiar with the Community Associations Institute. It is a great resource for not only specialists in the HOA world, but also a wealth of information for things like the restrictions from Fannie Mae, Ginnie Mae, any other items that you may have. So please reach out to your local chapter as well. I'll take the next one with the association officers using a credit card. Once again, having been a board member myself, Matt can attest to this. The idea of giving a credit card to a board member, I would ask as the owner, why do you need a credit card? That's why we have professional managers. Now, if you're a self-managed association, I can understand having a credit card to do certain items. But once again, I come back to this control idea. Everybody that's on this call is honorable. They all have integrity. But at the same time, like I mentioned in regards to that problem that occurred in Las Vegas, it would be, wait a second, this is a board-run organization. The board can approve these expenditures, and the idea of then having somebody go out with a check, or we like to use ACH transfers nowadays because you can track those. I would just recommend that there be certain controls put on any type of credit card utilization. The one thing that we did for an association back in the 90s that demanded that we issue them a credit card was I said, great, put a $2,000 limit on there. So if there is a potential for misappropriation or malfeasance, at least you know as a board, you're limited to a $2,000 loss.
Great. Let's see. Can
One
someone?
is me as well. Yeah.
Yeah.
The credit card that I'm referring to is once again issued in the name of the association. I think there's another question down the road in regards to giving up your social security numbers or your PII, your personal information. I always err on the side of conservancy. So if the card is issued in the name and the tax ID number of the association, as Ed mentioned earlier, you are a corporation. You are a not-for-profit corporation. So you do have a tax ID or what we call an EIN number. And that is how I would issue any credit card to any board members for utilization for minor expenses.
How can you reserve for an insurance deductible for a condo? It's a great question.
I think you can. I see communities do it quite often. It's not, I always tell them to keep that separate from your statutory reserves because it doesn't have a known useful life. It doesn't have an exact amount, but and I'll get in this debate. You can, I think you can save for anything. I'm interested in Ed's take on this. You can set up a savings account for that improvements that Nico was talking about. You know, you can, but it's not mandated. And I don't know that I would consider it necessarily restricted like I would other reserve funds that meet the statutory definition of reserves.
Yeah, I agree. I know it's been always my experience talking with reserve analysts, you get a little squeamish when it's something that's not tied to a physical component that you can look at that has a useful life or remaining useful life for funding purposes. But I also don't see anything that prohibits it, and I understand the reason for it. If it's like long-term, planning, we know we have this expense coming, and making sure that it's put aside for that purpose. I haven't seen anything that says you can't do it or run up against any problems with it.
So there's a question about adjusting the life of an asset, either adding or subtracting. How do you handle that, Matt?
Yeah, so This is always going to happen. As good as estimators as we like to be, we're not going to get it right every time. There's going to be adjustments. Especially comes into play with SIRS. I'm getting this question a lot of, we're mandated to fund this. Does this mean you had if you had the fence that had to be replaced or the railing that had to be replaced in 2028, do I have to do it if it's still in good shape when we get to 2028? And I think the answer is no. You have to fund to get there, but you don't have to spend the money at the exact amount and time that's shown in the reserve study. However, if you're going to adjust your funding and it's a SIRS, and I think Ed, you answered one in writing on this earlier, just you should probably get an updated schedule so that it aligns with the new replacement timing. That the contributions and the inflows to the reserves are adjusted in a manner that accommodates that new timing, whether it's sooner or later.
All right. SIRS
there were-
funds
Yeah, I
are
think there were a
you.
couple of questions above, Sherry, that we
Yeah, I
skipped
think
over.
I saw most of those had to do with credit card.
Right, credit card, and then a
And I
couple of
think
them
those were pretty already answered. Oh,
Yeah.
I'm sorry. The Treasury ETF money markets.
Right. There's two
That's the one I
questions,
missed.
both
Yeah.
from John and Nick. The ETF money markets, not insured, but if treasuries fail, our country would collapse. Absolutely. And that's the reason that I am completely against crypto. The idea of having a treasury money market is definitely acceptable because you're exactly right. It's our tax dollars. So it's our tax dollars that are supporting the government and supporting the treasury market. So yes, absolutely. The next one was in regards to government securities, bills, bonds, and notes, requiring that personal social security number. No board member will give their personal social security. If we go back to 2001 and the Patriot Act, every financial institution requires you as a signatory. If you're a board member and you're signing on the account, you have to give it up. That's a government regulation at this point, and all of us in the financial services industry have to get that information, has to be run through a government database before we can actually open the account. So you can do that. I normally recommend at least 1 or 2 board members that are willing to give it up out of a board of 4 or 5 or 6. Most people are reticent, but 1 or 2, like Matt and myself, yeah, we give it up to protect or help protect the association. And I think Liddell goes back to the credit card again, right?
Yes.
How are we supposed to function in the modern world without credit card purchases? A lot of these items are done online now. And yes, you can use the corporate credit card, or if you've got a professional management company that's working with you, it's their job to handle all these disbursements. I'm a volunteer board member. I'm not going to Home Depot to buy a sink.
Right. Absolutely. So I think we can jump quickly to the SIRS funds. If you use the reserve funds, how do you schedule them back to pay back the SIRS fund? So I think that's an internal accounting question for your manager on making sure that those funds, when they come in from your residents, are diverted, allocated to each of those correct funds. So whether it's SIRS or the non-SIRS. And if
Absolutely.
any, yeah.
I'll chime in and say, once again, to help protect the boards and the collective assets, you should have a separate operating account, you should have a separate regular reserve account, and you should have a separate SIRS account. Each of those items are then segregated. Monthly statements for each can be reconciled, and the funds can be utilized accordingly.
And if I might jump into, I know a lot of people receive insurance settlements. It is also recommended to have a separate account for those so that you can track insurance specific income and expenses. It's a lot cleaner for you and your association to know those repairs are being paid from an insurance settlement instead of commingled with other accounts. Not that that was asked, but I thought I'd answer. So- And then maybe this will be our last question from Steve about the reserves being used for operating accounts to pay bills.
I'm going to chime in first and then I'm going to turn it over to Ed. Absolutely not if you can avoid it. There are certain restrictions and or legal covenants that allow you to borrow from reserves to pay operating expenses. But I always say if you can avoid it, please avoid it. Have your budget done correctly. Work with your professional manager, your CPA, and especially your attorney to make sure that you're doing the right thing under the legislation as well as under your CC&Rs. Ed?
Yeah, so to add to that, I think that if there's statutory reserves, whether on the condo or the HOA side, the law is pretty clear that you can only use it for their intended purpose. Now, obviously, if you have pooled reserves, as long as it's for one of the pooled components, then that's okay. If it's a non-statutory reserve, there's more flexibility there. This issue came up a couple years ago, especially when we had skyrocketing insurance premiums, and the question was, look, do we either not pay our insurance premium or do we not fund our reserves like we're required to? It was a difficult one for us to answer. We had to give the conservative, boring legal answer, which is you got to refund your reserves and you cannot use it to pay your insurance premium if it wasn't set up for that, right? As we talked about before. So, usually, though, you're going to have to take a membership vote. If it's a non-statutory, if it's a non-structural reserve, you can have a vote to use it for other than the intended purpose. And just one thing, too, is be careful that I think on a day-to-day basis, what I see is an association having to fix their roof. Maybe there's a couple of repairs that need to be done, and they said, well, we have a roof reserve, so can we take it out of that? And Matt, maybe you can answer that better, but my answer has usually been, if you're not extending the useful life, which is a more like substantive, big picture type of fix, then that's an operating expense that you need to use your operating expenses for, not pulling from your reserves. But I get the creativity from pulling it when you have a reserve account for a similar component. But reserves are meant for long-term deferred maintenance or replacement, not for day-to-day repairs.
As
Yep.
treasurers with Matt and myself, I always recommend to boards that they have a contingency line item in their budget. And if in fact that contingency is just funded with a few pennies every month, these types of entities and maintenance planning is probably the best way to handle that.
Yep, on the operating budget, not reserves. I agree 100%. Yep.
All right, so I'm going to throw it back to Kevin. So after thanking the panel, this great discussion and all of you that attended, amazing questions, and I hope you all took a few nuggets of education off of this. Kevin, do you want to just let everyone know how they'll get a link to the video when it becomes available?
Yes, absolutely. So everyone that attended today will receive an email from Vesta letting you know how you can access all the presentation recordings and materials. When in doubt, you can visit vestapropertyservices.com/webinars or look for the webinars drop-down menu item. That's where we house all of our upcoming board certification courses, informational webinars, and all of our previous recordings and previous presentation materials. So if you sign up for one of these informational webinars or board certification courses, you will receive the follow-up email when all of the information is live on our website. Usually takes about 24 hours.
Oh, and one last question. Can you yes, I believe this can be shared, correct, Kevin?
Absolutely, yes.
Great. All right. Well, thank you, everyone. I hope you have a wonderful rest of your day and stay warm out there.
Thank you.
Bye,
Thank
everyone.
you, Sherry. Take care.
Bye.
Thank
Bye-bye.
you, guys.